For decades, the US dollar has been the backbone of global finance, dominant in trade, reserves, and international debt, but a quiet transformation is underway. More nations, especially in the developing world, are exploring alternatives. The Chinese yuan is emerging as a serious contender, challenging the dollar's exclusive power. This isn't a sudden collapse, but a gradual shift as countries diversify their financial portfolios to reduce dependence on the dollar. Economic necessity, strategic calculation, and a desire for autonomy are driving this change. The yuan is no longer just China's currency, it's becoming a global player, reshaping the architecture of international finance. Choosing the yuan signals a pivot in alliances and economic priorities, building a more multipolar financial world. The IMF is now openly concerned, as decisions in countries like Ethiopia, Kenya, and Sri Lanka ripple across the globe. Understanding this shift is key to grasping the future of the global economy. Let's look at how this shift is playing out on the ground. Ethiopia, after defaulting on a major Eurobond, is negotiating to convert much of its dollar debt to yuan, seeking stability and relief from a weak local currency. Kenya has already converted some of its Chinese infrastructure loans from dollars to yuan, saving over $200 million a year in debt servicing. These savings are vital for funding public services and development. In South Asia, Sri Lanka is seeking a yuan loan for a key highway project, aiming to avoid more dollar debt and align with a major trading partner. Even Hungary has issued panda bonds, raising capital in yuan within China. These moves aren't isolated. They're part of a coordinated pattern among nations seeking alternatives to the dollar. Each country, facing unique pressures, is finding the yuan an attractive option. Collectively, they're creating a new reality in global finance. The main reason for this shift: cost. Borrowing in yuan is much cheaper. Yields on yuan bonds are about half those of dollar bonds, saving countries hundreds of millions. China's approach is also more streamlined. Loans, construction, and trade often happen within a single ecosystem, reducing friction and costs. Western loans often come with strict conditions. China's are seen as more direct and less intrusive. There's also a desire to escape the volatility of the US dollar, which can spike debt costs when the Federal Reserve raises rates. Borrowing and trading in yuan offers more predictability and less exposure to US policy shifts. Diversifying reserves and debt is a strategic hedge, spreading risk instead of relying on a single currency. As China becomes the top trading partner for over 120 countries, holding yuan makes practical sense. For many, the yuan is now a pragmatic, cost-effective, and strategic choice. This combination of savings, partnership, and risk management is driving the yuan's rise. But switching to the yuan isn't risk-free. Most developing countries still earn dollars from exports, so taking on yuan debt creates a currency mismatch. Managing exposure to both currencies is complex and risky. Building up yuan reserves is tough. Yuan isn't as widely available or convertible as the dollar. Tying debt to the yuan means exposure to China's monetary policy, which may not align with borrowers' needs. The yuan market is less liquid and less tested than the dollars, making refinancing or crisis management harder. Countries could find themselves trapped if financial trouble hits. In short, swapping dollar risk for yuan risk brings new uncertainties. The IMF sees both the appeal and the danger in this trend. It acknowledges the real savings for countries like Kenya and Ethiopia, but warns of new, complex currency risks. Swapping dollar debt for yuan fundamentally changes a country's risk profile, introducing volatility and potential for crisis. The IMF urges that such moves be part of a careful, long-term strategy, not just a quick fix. There's also concern about transparency. The yuan system operates by different rules, complicating debt restructuring. If crises hit, coordination among creditors becomes harder, especially with Chinese state banks involved. The IMF fears a fragmented global system, with competing financial blocs and less cooperation. Its warnings are a plea to preserve the stability of the unified financial order. China's push for the yuan's global role is no accident. It's a calculated long-term strategy. Beijing has built currency swap lines with central banks worldwide, making yuan more accessible for trade and finance. The Belt and Road Initiative encourages partners to use yuan, integrating it into global trade flows. China's domestic markets are opening to foreign borrowers, with panda bonds deepening yuan's reach. Inclusion in global bond indices forces funds to hold more yuan assets. China isn't trying to dethrone the dollar overnight, but to build a parallel attractive system. Each country that adopts the yuan strengthens China's position, brick by brick. The yuan's rise is a deliberate reshaping of global finance. The rise of the yuan marks the start of a new, more complex era in global finance. The dollar's dominance is being challenged, but it won't disappear soon. We're moving toward a world where the dollar and yuan coexist and compete as anchors of international finance. For developing nations, this means more choice, but also more risk and complexity. Navigating between US and Chinese systems will test their financial management. For the global system, the yuan's rise could bring more competition and efficiency, but also fragmentation and instability. Two competing systems could make cooperation on crises and regulations harder. The internationalization of the yuan is now irreversible, tied to China's economic rise. How the US and institutions like the IMF respond will shape the future. We're witnessing a pivotal realignment, one that will define the next era of global finance.